All right. All right. Well, good day, everyone. We want to welcome you to our PrimePay Broker Concierge broker webinar, kind of our first monthly broker webinar of the year here in January 2018. We want to thank you for taking time out of your busy, very busy schedules to sit with us here today. For many of you that you may know or not know, we're actually entering our 10th year in performing these monthly webinars for many benefits brokers and certainly our broker partners over these many years. And for maybe some of you just joining us for the first time, I do just want to kind of lay out, hey, why do we do what we do? These webinars are really geared at taking some pretty generally complex regulatory guidance, complex technical issues, concerns, maybe complex strategies, and ultimately, within a webinar's time, be able to drill that down into a practical application. Because guess what? Your employers are demanding answers. They're running into administrative tasks that they've never experienced before. They're having to fulfill a requirement that they didn't even know that may have existed. And so they don't know what they don't know. And so you really have an opportunity with the information that we provide month after month to be able to give you this kind of tough content, but be able to give you some very practical applications so you can go immediately to your clients and provide real answers, the answers that they need and are certainly demanding from you. So we are thrilled that you have joined us. My name is Steve Jackson. I'm the Senior Vice President of Broker Concierge. And as you see here with the title here for today, New Year, New IRS Audits, New Tax Reform, and New Resolutions. Whew, that's a mouthful. As we think about 2018, certainly before we get even into 2018, the year end of 2017 is there was a lot going on, right? And as with most years, the end of the year is a good time to wrap up a lot of new business that's coming in for you, right? We've got a lot of renewals that occur, but Congress is always generally trying to fit in as many legislative types of changes as they can prior to their holiday recess. And this last year in December was no different. And so as we've come into 2018, it is a new year, but it comes with it packed full of new kind of compliance measures. And we want to try to break that down. In January, our January webinars have always been filled with actually wonderful opportunities to break down really strong content. And so I'm excited to bring this content here for you. Let me just cover some of the ground rules just real quick here before we get started, because we do have a lot of content here today. I've muted everyone's lines. We've got a lot of folks on here today, and that's great. It is great to at least see many of your names, those of you who have participated quite a bit with us in the past, and love to see a lot of those new names that are appearing here as well. So thank you for joining us. So what we'll do is we've muted your lines, but we still want to take your questions. So if you have a question that arises as I go through the presentation today, please feel free to go into the Go to Meeting menu box, the question box, type in your question, and go ahead and send it to me. Okay, submit it. It may be possible for me to answer the question during the presentation. Due to the amount of content today, I don't know what I'm going to be able to get to at the end. So if I can't get to your questions, we will absolutely follow up with you after the webinar here today. All right. So I mentioned here too, you see here on the screen, Broker Concierge. I encourage you all, if you've not sought to get appointed with us here at PrimePay through our Broker Concierge Partner Program, you're probably missing a lot of exclusive material. And one of the things that we do typically with our monthly broker webinars is that in our follow-up email, we will always provide a link to our recording. We do record these and we post the recordings on our Broker Concierge YouTube channel. And that's a public channel. You can go there at any time and see all of the recordings that we've done, or at least the many over the last several years. Okay, so they're all there. But for you who are not BC partners, you miss out on a few other things. So for one here today, for our BC partners, our broker concierge partners, we are going to be providing the slide deck presentation that I'm going through today. Plus, there is actually a pretty nice flyer that you can present to your clients that details this kind of IRS employer mandate audit, this letter 226J that's now going out to clients. And I think you'll find that very helpful. So if you've not checked into or checked out our Broker Concierge program, I'll provide at the very end some details on who to call, who to connect with, and we'd love to have you join us because for 2018, we are dubbing this year, as part of our Broker Concierge team, the Year of the Broker. And it's our task, it is our objective to enhance and equip your agency not only with a vast array of employee management solutions that we provide here at PrimePay, but equipping your agency so that you can actually meet most of the objectives or all of the objectives that you have laid out for 2018. We want you to succeed. We want to help you succeed. And we do that through our Broker Concierge program. So, all right, enough there on the logistics. Let's kind of go through the agenda here today. As I had mentioned, I've got a lot, as I always do, and we're going to cut through this first part pretty quickly to get into the response of IRS Letter 226J. But some quick updates. Some of you might have seen recently the Department of Labor's proposal of the Small Business Health Plan expansion. So I just want to touch on that briefly. I also want to just provide some quick bullets on the cost of living adjustments for some ERISA non-compliance penalties, okay, on ERISA. These, and let me say, these adjustments do not decrease. They are not going lower. They're going higher. So it's more to reemphasize the need that your employers need to, the steps they need to take to gain compliance. And then lastly, and under the quick updates, is the health and welfare benefits and the new Tax Cuts and Jobs Act. What I want to do is just do some highlights, okay, of the Tax Cuts and Jobs Act, and highlights primarily focused on the benefit side. What does that mean here for 2018? There's been some confusion in a couple of areas, and so I do want to try to provide some clarity with that, okay, and hopefully I will today. And then the majority of our time today will be focused on the response to the IRS Letter 226J. It sounds so formal, but yes, the IRS is a formal agency, and their proposed assessment of the employer mandate or their enforcement of the employer mandate has generated these letters. And I think it is prudent, as you are the trusted advisor, to be able to walk your clients through this process. Make it known that I've done this before. Yeah, I got it. I got you. I'm going to help you through. I'm going to make sure you understand what you need to do. All right. I mean, the letter is pretty clear, but the steps that you need to take, whether you agree or certainly disagree with their assessment, means the world. And so I hope to provide some insight to those steps and at least allow you an opportunity to be able to speak to your clients ahead of time before maybe some of these letters come out. Okay. All right. So let's go ahead and get started. I first want to tackle at least a couple of these legislative updates. And, EBSA had published a news release here on January 4th that stated that they had an expansion, or they proposed to expand access to healthcare through small business health plans. So think about association health plans. And in some regard, you sit here and go, well, Steve, I mean, we have some of that going on now. We have MIWAs, or multiple employer welfare arrangements. I mean, those are certainly prevalent out there today. We have some of these arrangements today, so what is different? And so, in large part, there are some subtle differences, right? I think some of the communication that's come out of these departments has been, well, listen, the current arrangements that are out there today, we've not been able to enforce them like we could or should. We don't feel that these arrangements have communicated to us in the right way or in the right manner. There is fraud that's a little, well, I don't want to say rampant, but there's fraud certainly in this area to some degree. And so what they're trying to do is trying to drive a more concise type of a association health plan model, okay? And they're calling it small business health plans. And so a couple key bullets, okay, that I take out of this. You have small employers may participate on the basis of geography or industry. So, we're kind of removing just a specific industry. It's more like a chamber association, right? I mean, you've got employers of all looks and feels, in your specific geographic area. And so small employers alike, whether they are alike or not alike, as far as industry, they can participate. It also permits sole proprietors to join these plans. So, you think a little bit about, well, don't we have the shop? I mean, we have a small business exchange, right? I mean, many employers did not go in that direction because they didn't qualify for the small business tax credit. It really didn't have a tremendous amount of options available to them anyway. And so now sole proprietors joining these small business health plans, interesting. I mean, they currently state that there's 11 million Americans working for small businesses and sole proprietors and their families, and that lack actually some resemblance of employer-sponsored insurance. And so permitting these sole proprietors to step in and join, they really feel, they can finally participate in employer-sponsored types of insurance. Now, they've not talked yet about the types of insurance. There's a lot of discord, I'm sure, in that discussion where, well, are these going to be ACA compliant plans, Obamacare type plans? Or are they going to be something different that's not minimum essential coverage, right? So there's going to be a lot of debate that's going to be going on here in regard to these kind of association health plans. A couple other bullets here that I list, they state, you cannot charge different rates for different types of employer groups. There can't be any disparity, right, between the groups that are within that specific association health plan, okay? And also, there's limited ability to sell across state lines. And I'm going to be honest, that's in written form, that's easy to write those words. But I would say in practicality, we do not have that in practice today, right? So there's maybe limited ability. We'll see where that goes. But the bottom line is, as this was published January 5th, there is public comment for the next 60 days. So if you feel impassioned to share your story and your opinions, please do so, because at the end of the day, we do see this transformation occurring. Now, whether all of the features and benefits are going to be included, that's going to be decided clearly. But we do see this happening, and we see some changes afoot, and they will make it easier for small businesses to be able to partake in some of these. So you got to really think, right? Think about it from a benefits broker standpoint. How does that impact you? I don't believe I've seen an early statement from NAHU, from the National Association of Health Underwriters. I don't know if I saw anything just recently, so I apologize if they did publish something. But it will be very interesting to see what our overall take is and how brokers can continue to be involved and flourish, where I think you can, but really flourish with these types of plans. All right. ERISA penalties, you got to keep up to date on these things. The Department of Labor themselves state that 3 out of 4 employers are out of compliance with ERISA. Here at PrimePay, I'm going to tell you they're wrong. It's actually 9 out of 10. Employers do a very woeful job of staying compliant with ERISA, and I'm talking those employers that are 2+. Right? It doesn't matter your size. If you offer an employer-sponsored plan, you need to comply under ERISA. And these penalties, some have some statute of limitations, but as you see there, the last bullet there that's listed, failing to file Form 5500 from the day that it is late is over $2,140 per day. Now, these are the maximums that I am showing you. This does not necessarily mean that the or EBSA, the Department of Labor, can actually, or they're going to enforce it up to those maximums, but it does say to the extent how far they can take it. That is per day, and if you just start doing some math, if an employer failed to file over the last 3 years, 2 times 3, I mean, these numbers get pretty heavy pretty quickly. Failing to provide an SBC, $1,128. There's simple things, carriers provide a lot of times, or TPAs provide these summaries of benefit coverage. But who's distributing, those SBCs to their employees? So employers, the plan sponsor, is ultimately responsible, okay? And so just do understand, I guess it was, a year ago, so 2016 actually, is when we really started to see a more a greater annual schedule that's tied to cost of living adjustments or the public dissemination of these adjustments on an annual basis. And so these were just taking effect here as of January 2nd. So you do just need to be aware of these 4 specific highlights, here today. There were some additional cost of living adjustments, and they go back to, I believe, around August of this year is when some additional adjustments actually had occurred. Okay, again, we're going to do some key highlights here, folks, but I want to talk on the Tax Cuts and Jobs Act, just touch on really more on the benefit summary. I mean, if you look at, tax changes generally here with this act, it's going to affect businesses and individuals completely unevenly, right? I mean, there's going to be winners and losers, right? And I'm not going to spend the time here today to certainly get into the political stance and debate this with you. We're just going to cover the facts. I mean, if you're part of Philadelphia, we like to keep it real. So we're just going to focus on keeping it real here today and just focus on those highlights. But I'll let you guys debate that on your own at the water cooler in the coming weeks to come. So just a couple highlights. I know that I show a couple tax items, even above and beyond some benefit items, but I just wanted to touch on a couple things. The child tax credit, which I didn't put in here, actually was doubled as well, went up to $2,000 per qualifying child. They've now even made it refundable up to $1,400, and it starts to phase out at a $400,000 in income. So there's some changes afoot there. And we also have the very wonderful, kind of on the other side of the coin, the new law limits state and local tax deductions, right? So it only allows for now the deduction of up to $10,000 in state and local sales, income, or property taxes. And that's that SALT acronym that you see out there. So there's plenty to debate about. There's plenty to say, there's so many advantages and so many disadvantages. So you see there, as far as the standard deductions, it goes to $12,000 for individuals. I think head of households is actually at $18,000, and then $24,000 for married couples filing jointly. Okay, and then a big move there. I'll jump one bullet there to the corporate tax rate. I think what we can all more generally agree is that this is going to benefit corporations, right? So that goes down to a 21% corporate tax rate. And there's even an opportunity for those pass-through corporations, so those sub-S chapter corporations, those shareholders, to even see a 20% deduction for qualified business income, as that is often passed through, to their individual returns. So, so corporately, and even, from an individual, clearly there'll be winners and losers, but we've got some good facts here to talk about as it relates to benefits. Repeal of the individual mandate. Right, the net result of these changes is that no shared responsibility payment will be required, okay, after 2018, nor will there be any penalty imposed for failing to maintain minimum essential coverage. Think about what that could mean here in 2018, depending on how you roll, right, as an agency, what you deliver as far as part of your services. There's opportunities there in regard to this repeal of the individual mandate. So, one thing clearly that remains status quo, as I have on my other screen, or that actually I didn't put there, but I should have, is the employer mandate. So the employer mandate is seeing no change, right? The reporting requirements are still there. The penalties still exist. All of those specific requirements as far as offering coverage, offering affordable coverage is still going to be in place. Let's move over to the transit and parking benefits, okay, a change. So one of the changes here to this fringe benefit was that it removed the deduction for the employer contributions to a transit and parking benefit account. So for those of you who may not have had a lot of experience with these are pre-tax accounts. And an employee in the past, an employee and an employer could make contributions, either taking out as salary reductions, out of an employee's W-2 wages, and be able to pay for that. It would allow that employee to pay for their out-of-pocket commuting expenses. So train, bus, subway, and also parking. It gave, it's their ability to commute to and from work each and every day. So what has changed, in the past, an employer could deduct what they contributed on behalf of each employee. This new act removes that. It eliminates that. So an employer cannot contribute to transit and parking benefits, nor, clearly, or even receive a deduction for it. So an employer might, they could, in essence, gross up someone's wages, which is potential, for that employee then to make contributions on their own. And I'll talk about that here in a second. So the employer deduction was eliminated. This next one might only affect, a lot of the big or larger municipalities, San Francisco, New York, or LA. Clearly, where these bicycle commuting reimbursements were a little more prevalent, they have been suspended through 2025, so there is no more reimbursements or tax-free reimbursements from an employer to an employee for commuting to and from work on a bicycle. There were certain limits per month over 6 months that in which an employer could reimburse for bicycle commuting expenses. That has now been removed. FMLA. This is interesting, folks. Let me tell you, this is very interesting, okay? This allows businesses, okay, this FMLA credit for employers, it allows businesses to claim a general business credit equal to 12.5% of the amount of wages paid to a qualifying employee who was on family medical leave. Now, there are different rates. There's a couple different factors as far as, well, how much wages were you providing that employee during that period? Was it 50% of the wages? I mean, what were you actually contributing, paying that FMLA employee during that period? Based on those factors, it would enable then an employer to receive maybe a greater credit or a reduction in credit, okay? But this is a new opportunity here for employers. And so anyway, the FMLA credit for employers, that was a new item here that's been added. Expanded 529. I know some of you, we hear from some of our brokers, you get involved a little bit with providing or at least making recommendations to 529 plans. And so there was an expansion, very interesting. As you know, 529 plans has really been a college saving tool, but they now have opened it up to use dollars up to $10,000 per year towards tuition for elementary or secondary, public, private, or religious school types of expenses, okay? So kind of interesting, huh? Right? So anyway, an expansion. And then lastly, it seems like there's a new model for this every year, but cost of living calculations. There's going to be a new model, folks. And what I've been told based on what I have read, that the cost of living calculations will be on a little different factor. It will not be increasing as much. So for instance, if we would have seen a 4% COLA increase based on, the medical inflation and so forth in the previous year. Based on this new calculator, we might see more of a 3%, type of a rate. So it's actually going to slow the increases down a little bit. Don't know if that's a good thing, bad thing, but just do know that has occurred. Now, there's also, we have the status quo, and I do want to focus because I already see a question on this here already. But one, the excise tax, no change. Employer mandate, no change. All right. What was in the House and Senate bills was some conversations going back and forth about dependent care accounts and adoption assistant accounts actually being eliminated, but they actually remained in the act, in the bill, in the final bill that was passed. So that remains active. No change to dependent care and adoption assistance accounts. There was no change to allowing over-the-counter drugs to all be considered qualified expenses. So the same rules apply. Over-the-counter medicines can only qualify with a prescription, okay? So, with the prescription, no problem. But then the next item, and it goes back to the transit and qualified parking expenses. What is still permitted is that employees can still take money, deduct as salary reduction, dollars from their paycheck on a pre-tax basis to pay for their transit and parking needs. So the transit and parking accounts are still available. They're still there. They are still active. And an employer will still receive the FICA match, the 7.65% match on those contributions or those elections that they make. So even though an employer can no longer contribute to these type of accounts, they still can receive that FICA match. Okay, so do know transit and parking is still alive and well from an employee perspective to be able to pre-tax those contributions. And then lastly, all these like little nuances, right? Something that certainly remained that's been there is what employers pay. Certainly 3.8% net investment income tax, that is still going to be in place. And then from an employee or individual kind of tax, if you will, is the 0.9% Medicare tax, okay, that additional tax that was added. So that's also still going to remain. So there's some important things that's part. I mean, I'm excited and then kind of concerned, right, as we enter 2018. But from a corporate side of things, I think that there's real advantages in the act and is a real opportunity for employers to be able to reinvest, hopefully, those savings and reinvest that into their employees and certainly their business, creating more opportunities, hopefully, for us all. All right. So that's some quick and dirty highlights on those key items. I think very interesting things that you all need to stay on top of because they're going to change a little bit here and there, right? I mean, in fact, these tax cuts, it's only good here till 2025. It's not permanent. So guess what? There's going to be a tremendous amount of debate and dialogue on this issue here even yet. All right. So a big area of concern, we were unable to hold a webinar at the end of the year to kind of cover this specific strategy and opportunity, or at least certainly administrative task now that an employer and many employers have had to go through. Back in November time period, the month of November, the IRS is said to have issued over 100,000 letters 226J. That's a lot of letters. So if you think about it, the IRS has had this clear obligation to enforce the employer mandate, right? I remember going back to 2013 and 2014, this conversation that I've had with many of you and with employers going, oh, come on. I mean, so how are they even going to force it? I understand that statute 6055 and 6056, which is the individual mandate and the employer mandate, it's forcing us down this path. And if we don't go along with it, we're going to pay these penalties. But who's going to know? Who's going to know if I offer coverage, if I made it affordable, blah, 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 right? And then came along, certainly, Forms 1095 and filing forms, the return form of 1094. And that really opened up the window here for the IRS to be able to actually strategically and a little more clearly ascertain which individuals, which employers were following that mandate. And so as they finally kind of got their act together in regard to capturing this data and reviewing this data, that has now prompted the IRS to begin sending these letters, which is titled here 226J, and these are proposed assessments. It's simply saying, although it looks kind of bad to a degree, it's simply though saying, hey, look, we've done some research. We have found that one of your employees, individuals, has qualified and received a premium tax credit, okay, of some kind. And we're also seeing from Form 1095 or 1094 that you may not have offered coverage or, you know, what have you, right? And so they have produced these letters. Now there is, before I go to the next screen and we kind of dive into this here just a little bit, you know, there are certainly some debates going on right now as to legalities and what is enforceable and what is not. Some of you may be aware, and this is a lot of chatter is going on about this right now. I don't know if you recall, but the final regulations required that an exchange, a state exchange or federal, okay, must furnish what's called a Section 1411 certification. And basically what that does is that it notified an employer, it's a notice that went to the employer that informs them that one or more of its full-time employees received a premium tax credit. Now, there were only a handful of states, and I don't have that list right on my brain right now. I know Connecticut was one of them, but I can't speak to everyone, that actually did send those notices. Most exchanges, including federal, did not furnish this statement. And so I know some attorneys have already gotten a hold of this, and you know, certainly they feel, based on these notices not going out, that it actually precludes them from enforcing this employer mandate and the penalties therein for the 2015 calendar year. So interesting, right? We're going to see how that kind of plays out, but do know that there's a lot of chatter going back and forth right now, at least to some of the legalities. Now, I can't speak as to where that's going to fall. At the end of the day, the IRS is actually pursuing enforcement of the employer mandate, and they're enforcing it through Letter 226J. Okay. Now, so just let's kind of review this here a little bit, because shoot, I can't remember 2017, let alone 2015. Let's try to go back and see where do we stand here. So this letter that first we started to see out of November of 2017 is about tax return year 2015. Okay. So let's just go over some of the, I guess, the ground rules of that year. So the penalties at that time, the A penalty, which was the penalty that says, hey, do you offer coverage? Do you offer coverage that is minimum essential coverage? Have you provided it to at least, well, in subsequent years, it's 95% of your full-time employees and dependents. But in 2015, it was 70%, okay, in 2015. Also, the 4980H, which is really the definition of an applicable large employer, okay, that who would be deemed that would need to conform under the employer mandate. So 4980H. A, which is the penalty A, is calculated by reducing the employer's number of full-time employees by the employer's allocable share of 80. So in subsequent years, you know, we would take 100 full-time employees minus 30, and that was your the amount of employees that would be deemed could be deemed as where the penalty would be applied to. In 2015, it was 80, okay? So the A penalty was $2,080. That's for the year, prorated $173.33. Then you have the B penalty. Okay, you offer coverage, but have you made it affordable, right? And so that penalty in 2015 was $3,120 or $260 per month. Now the B penalty, we sometimes call it the tack hammer penalty. Not as bad as the sledgehammer penalty, the A penalty, but tack hammer, it still hurts, but it really only is charged to those individuals, not all your full-time employees, but only those individuals who received a premium tax credit. All right. Also, in 2015, if you recall Forms 1094, there were certifications of eligibility, okay? There were opportunities in 2015 for employers to either find transition relief, okay? And these were the 4 items that were listed. Now, I'll share with you just here in a little bit that, some of the failures in the assessment by an employer has been that they failed to adequately mark the certification of eligibility, right? So there's different varying definitions. The 98% offer method was set up so that, hey, if you're providing coverage to over 98% of your full-time employees and dependents, blah, blah, blah. And what the qualifying offer methods offered was, if you met that definition, instead of you having to do a 1095, you're able to use an alternative form, okay? But what most employers found was, why do another form? I got to do all that work. I might as well do Form 1095 because it's basically or virtually the same amount of information that I'm going to put, otherwise. So, but the big one that was checked or not checked is the Section 4980H transition relief, and there was relief available for employers between 50 to 99 full-time employees, if you recall, and for employers with 100 or more full-time employees. So also that entailed non-calendar year. Did you have a fiscal plan year, and you fit into this 50 to 99 category or 100 or more category? Did you start your plan year, say in November 1st, 2014, into that 2015 year? I mean, you would have coded something differently on 1095 and 1094 to reflect that, okay? And so these specific rules were in place. So as we think about these assessment letters, we need to be thinking about, well, what were the real penalties and requirements for us in 2015? All right, so what I want to try to do is, from a very high level here, provide a couple different looks at this. This first look is kind of an assessment workflow. This is an IRS workflow. All right, many of you, because it only, many of these smaller employers under 100 would have had some relief because of the transitional relief, okay? It doesn't mean that they didn't have to report, right? Any applicable large employer was still required to report on 1094, 1095. They were still required. But the transitional relief enabled these maybe smaller employers, 50 to 99, not have to comply with the mandate. They comply with the mandate, they just aren't penalized for that. So you might have many of your groups that this did not apply, right? It's your larger groups. Many of the letters, the notices that I have seen, have been for groups well over 100, 100 plus. So what I want to show here is just a quick assessment workflow from the IRS, okay? And hopefully kind of go through this pretty quickly, all right? So I've just kind of broken these into steps. So letter 226J, step 1, all right, this is the primary letter. There is nothing in essence that an employer needs to do ahead of time to prepare for that. They just need to wait. In most instances, an employer is not actually going to be able to recognize if they've not received a notice from the exchange. They're going to have no idea that a specific employee or individual that was employed back in 2015, if they qualified and received a premium tax credit. not going to have it, right? Not going to know it, because most exchanges did not provide that specific notice. So letter 226J is that primary letter. And again, keep in mind, it's assessing potential liability. They're basically saying, okay, we're looking at individual records. They reflect that their employed was employed, but they qualified for a subsidy and got a subsidy. Now I looked at your 1094 and 1095 employer, and I see some holes in there. I'm seeing you did not offer coverage, or at least that was your code that you put on there. So again, they're matching those, comparing notes, and then driving the specific letter to you or to the employer. Now, many employers already know that they're going to be or have the greatest potential of getting assessed, okay? Those employers should be prepared. I hope in any situation that they have actually set money aside if they know they clearly would owe this money. We've already run into certain situations where that is indeed the case. So you receive first the letter 226J, and the applicable large employer has 30 days to respond, okay, and take action, all right? So 30 days, and we'll bring that up a few different times. Step 2, okay, now, so just think with me here, the workflow process from the IRS. Once you as an employer respond to the assessment, there will be an acknowledgement. There will always be an acknowledgement, and that's letter 227 that's issued in response. That's an acknowledgement of I'm in agreement, we're not in agreement, and so forth. If there's an agreement, meaning the employer agrees to that assessment, then the IRS will create a notice and demand letter for the balance due. And if the employer just disagrees, okay, with the findings, we're going to move here to step 3. So if the employer is saying, okay, if he agrees, we basically end at step 2, and we pay the bill in essence. But if we say, well, no, we disagree, okay, what you are able to arrange is a pre-assessment conference request. I will say this, in any audit situation, if you or your clients have dealt with a Department of Labor audit, it is always, or IRS, it is better to keep communication flowing. So we do encourage employers that are potentially disagreeing with those findings, with that assessment, that they do hold a pre-assessment conference, with the IRS in this instance. Now, you do want to review Publication 5. That's the appeals language and how to appeal and so on and so forth. But you can conduct this via conference call, phone, a personal conference as well if needed. So as we go to then step 4, if you disagree, okay, then you would receive an acknowledgement. So again, letter 227 in that disagreement. And then if the IRS agrees with your response, no further action is going to be taken. If the ALE is determined liable, then notice demand for payment. And one thing to keep in mind, the last bullet, the applicable large employer cannot include the ESRP payment, that employer shared responsibility payment on their tax return. It cannot be deducted. We recently had a client what do they have? 150 employees. They were assessed just about a $260,000 ESRP payment. Okay. They did not offer coverage, so they're going to owe those dollars. But that $260,000 cannot be deducted on their tax return. Okay, so it's hard and fast money here that's going to the IRS. So keep that in mind. So basically, what you have is the initial 226J. You have your response, and then an acknowledgement, whether it is no action taken or payment is due. There are 2 specific items that are listed on 226J, okay? And I do see one of the questions, so I think we'll be able to tackle one of these here. But certainly the employer premium tax credit, this is going to list the individuals that the IRS says from Form 1095, okay, well, what did you put on there? You listed that Donald Duck, you have a 1H code here for all the months of 2015. 1H means no offer of coverage, okay? I didn't put the code listing up there, definition. But then you see No PTC, okay, or PTC. No, that's premium tax credit. So it's going to detail when no premium tax credit is actually provided, during which months, okay? So January and February, Daffy Duck did not have any premium tax credit, but we can probably safely assume that there was premium tax credits for the rest of the years. So this is something to review. Now, an employer can make adjustments to this particular report. You see that there's actually a secondary column here and just underneath what they had written, and that does allow an employer to be able to reflect changes to be made, but we would also recommend that you actually reflect the Form 1095 that you actually had produced, for that specific individual. There's also another table that is shown in this letter 226J, and it's the summary table of information that's reported to the IRS. This is the return. This is the 1094, right? And so it's going to, I just try to highlight a few things here. Under column A, it's all of what you have already stated on 1094 on that second page, where you write, did you offer minimum essential coverage, your indicator, 70% or 95%? What was your full-time employee count, right? The mandate penalties are going to flow off of that full-time employee count. We've got, here's the count of accessible full-time employees with a premium tax credit. That's penalty A. And then you've got penalty B listed here as far as affordability. And then lastly, column G, you have the monthly ESRP amount. So the IRS within this assessment is going to provide a month-by-month computation in regard to the penalty, okay, for each and every month, and then tally that up. So very important that as an employer, you review exactly what that letter states. Like I said, it's very clear, but there is a tremendous amount of information in it. And so this demands an employer response. And so what I've tried to do here is just provide some preparations. Here's some, I can't go too granular here within the webinar here today, but I wanted to provide some easy steps that an employer can make as they prepare to, let's put it this way, disagree with the IRS's findings, okay? And so the first step here, this is a no-brainer, right? But they get the 226J, read it carefully. As you are their benefits broker, you need to be involved, okay? In every single one of the letters I think that we've received, we've actually gotten it from the broker themselves. I mean, this is, brokers are definitely being engaged, not saying that you're doing the work, but you're engaged in the process, and you are the most trusted advisor as it relates to the ACA, Affordable Care Act. So it clearly, this letter, as I state there, it clearly defines the computation and steps to respond. So do it immediately. I just got into my possession here today, this morning. I received another notice from an employer. It was dated January 5th. They're just getting that to us today, the 10th. We have already lost 5 days of work to prepare for this response to this assessment. No. You begin the steps immediately. So you go to step 2. You got to start accessing the documents, right? As you look at that assessment, the employer should start gathering any internal files, or certainly start reaching out to any of their outsourced providers, right? Payroll providers, whoa, key partner in this. Payroll data comprises about 65% of all the data that's required for Forms 1095 and 1094. It's huge. So payroll providers, the payroll partner of that client, can help out tremendously. Whether they're providing ACA solutions or not, they still have very important data. You also want to access the information from ACA Administrative Solutions. Here at PrimePay, we provide a tracking, reporting, and filing solution. So it's a complete tool. At any point in time, an employer can actually run a report, download a worksheet. They can see affordability. I mean, they can grasp at whatever they need to grasp. So it's an ACA Administrative Solution is oftentimes going to be one of the first starts that can be made if the employer had done what they needed to do. You also can gain a lot of benefit detail, open enrollment activity, eligibility information, elections, waivers, coverage details, types of coverage directly from that benefit administrative platform. And then lastly, but not least, is the trusted advisor. You as the benefits broker, employers may have used a CPA, certainly in the past. So assess, gather. You got to gather those documents, and then begin to review. Let's make sure we begin kind of at least first an internal audit. Do a thorough review. Do we have all forms 1095? Let's look at the individuals that were listed, okay, on the letter 226J. Let's see how our data compares, right? You want to look at measurement periods. You want to look at maybe your ERISA SPDs. How have you defined an eligible employee, so on and so forth. So review then those documents that you've now been able to gather. And then you've got to compare notes. Compare your findings with the ESRP summary table and the employee premium tax credit listing. Do they have the individual correct? Well, I think so. But you know what? They didn't have the full-time employee count correct. So I'm going to need to show proof that it actually was a different number than what was stated there. So you've got to have and offer that backup. So compare notes. You got to go right after what was listed as to what they feel, hey, these guys received a premium tax credit. You're going to have to prove to us that you offered coverage, that you, offered MEC coverage, you offered it to 70% of your full-time employees and dependents, and you made it affordable, right? And that's going to take them off the hook. You also do want to really review any of those employees who are variable hour employees. Many of these individuals could be those variable hour employees. And the IRS did not see your measurement periods, right? So you're going to have to reflect those periods and what those results were. And secondly then, or lastly, I should say, in this kind of prep work, you either are prepping for disagreeing with the assessment or you're agreeing to the assessment. And so to prep for the disagreement, you're going to enclose a signed statement of why you disagree in whole or part for that letter. And we're not talking, that's not just a simple letter, right? You're going to have to back that up with employee handbook language, depending on the situation, forms 1095, 1094, payroll data. I mean, you're backing that up with a tremendous amount of data. You're going to describe any changes, if any, you want to make. I made a mistake. I need to make this change. Here's why I need to make that change. Show that proof. And you're going to make those changes on that premium tax credit listing, okay, that comes with that letter. And then certainly provide additional and all documentation to support your changes. If you agree, that's pretty easy as far as prepping for agreement. Complete, sign and date the form for the ESRP response, include your payment, and if you don't include a payment, they're going to initiate a notice and demand for the balance due, right? And you pay that bill. Let's talk about common failures. The first one that I noticed, and I'm not saying I'm seeing it pervasively, but like I saw that employer letter here this morning, we've already wasted 5 days. Let's go. We've got plenty of work to do to ensure that we properly disagree with the assessment. And generally, hey, you need your 30 days. To get that done. But the bottom two are very common. A lot of employers that are disagreeing, they just don't have the appropriate substantiation documentation available. And it's why we encourage employers to, if you just had an ERISA summary plan description, it defines an employee, it defines waiting periods, eligibility periods, it defines your measurement periods. There's so much. You just go, here's my SPD, go. Here's all the information. Plus, if you're utilizing a ben admin system, for regular benefit administration, also maybe an ACA solution through payroll, you're going to have that many times, that substantiation, but many employers do not have it at their disposal. And the last area and the most common failure, and it's not that an employer needs to get angry about it. They may have made a mistake. They forgot to actually indicate the correct transition relief rule on Form 1094C. That's line 22 on Form 1094. And so if they did that wrong, they just need to make those corrections, okay, as they respond back to the IRS. But those are very common types of failures here right now that is going on. I thought what would be helpful is also to share kind of documentation sources. There's some common pieces of the employer mandate that's part of this proposed assessment that they are going to have to remedy. They're going to disagree and they have to prove otherwise. And so I thought, well, it might be helpful to kind of see, well, where do I go to get this information? And so one of the first items, right, you do have to prove as an employer that you offered minimum essential coverage, or a plan that provides for minimum essential coverage. So you need to provide that proof. Generally, that's a little easier, certainly to ascertain. That's going to be, gotten by the insurance carrier, the benefits broker, third-party administrator, is going to provide those details. That could potentially be in an SBC notice. It could potentially be a benefit summary, insurance certificate, what have you, that would provide for that information for minimum essential coverage. Okay, so that's kind of easy. And I would say many times you have that information, or you know where to get it, right? The next is minimum value. I know it confused a lot of employers in regard to, okay, I'm providing minimum essential coverage, but okay, with minimum value, and that's that actuarial value, the 70%, 80%, 90%, so forth. And so generally, insurance carriers for fully insured plans will be able to drive the best detail, whether it's through an SBC or otherwise, in regard to minimum value. And then for self-funded plans, clearly third-party administrators will be the avenue to take to gather information on minimum value. Full-time employee status. Now, what you have to focus on is you do have to prove, right, to to the IRS that this said individual was or was not a full-time employee. So you need records and information to back that up. That's hours worked, could be hours earned but not worked, PTO, sick days, whatever, FMLA, could be many things there. So you have to be able to track that. Also employee classification is very important. You may, from a source, you may need to look at your employee handbook or an ERISA SPD to reflect, well, listen, we've defined a full-time employee as, and being able to back up your answers with your definition and how you go about it is very, very helpful. Encourage employers to utilize those definitions as they respond. But also payroll providers, right? Where you're going to get most of this type of level of detail will be certainly with payroll. Now, I also want you to think about, actually, no, I'll get to offer of coverage here in just a second, actually, on the next page. The next is affordability. Employee affordability is a big deal. The penalty is less, but you're still going to have to reflect that an offer of coverage was made and that you made it affordable. And so payroll is going to provide a lot of great information as it relates to employee contribution amount, certainly, and to wages. But an ACA compliance tool or possibly your ERISA SPD might provide additional information about your safe harbor calculations. Did you use the W-2 safe harbor, rate of pay safe harbor? Did you use the federal poverty line safe harbor? You need to back that up. What was your calculation? How did you get to that determination based on these individuals? And so when you look at what's needed for affordability, and I even write there open enrollment materials, maybe you want to see, did I offer this individual coverage? Were they even eligible? So offers of coverage there is good backup here, even for the affordability. But Ben admin systems, ACA solutions are perfect as sources for affordability. And then lastly is the offer of coverage, right? This is where, and we've talked about this before, employee classifications are huge. An employer must be classifying employees correctly, based on the facts and circumstances of you hiring that individual. Were they full-time? Were they a variable hour employee? Were they seasonal? Were they part-time? So on and so forth. So an offer of coverage, a lot of times, the IRS is not going to know whether they were considered a variable hour employee, and that after you have measured them through their period, they were deemed to not be eligible, or they were eligible but, decided to waive coverage, whatever it may be. So the ERISA SPD is perfect for reflecting measurement periods, the definition of eligible employees, but you're also going to get a lot of this information, too, from the payroll provider, benefit admin technology, and certainly an ACA solution, there as well. All right, so the path to success. I mean, so that's a lot, right? There's a ton there, but I'm telling you, there's only several pages, but there is a tremendous amount of work that an employer will need to do to certainly disagree with this particular assessment. And one of the first things that if I could ask you to do, is to simply make yourself available. Believe it or not, you are the most trusted advisor as it relates to this specific procedure, to this specific mandate. You are sitting in a pretty wonderful spot to create some client dependency here, but you got to get ahead of it. Okay. In 2015, because of the transition relief, many of your clients, we didn't have to worry about them. Okay. I mean, we don't have to worry about their specific penalties being assessed. 2016, it's very different. So you need to understand what each of your clients are challenged with. Are they going to have a real problem assessing or accessing their documents that are needed to prove that they disagree with the assessment? What are their needs? Are they utilizing an ACA solution? You ultimately need to get them to strive for more integrated systems, right? By having all these disparate types of, filing cabinets and technology, they need to try to integrate these solutions together. So certainly an ACA solution and payroll integration, great. Ben admin, ACA, great. But honestly, you need to actually get all three, if you can, combined together from an ACA, payroll, and Ben admin. That certainly is the best practice. Also consider, as you're talking to your clients now, prepping them for what's coming. Many of you, as I've talked with many of you, thought, okay, all those letters are done. They sent them all out in November. There's 100,000. Okay, no more. Phew, okay, I'm done. My clients are good. I just got one that had a letter dated January 5th, and it was no small company. So there is still plenty of work to be done here right now, and I do firmly believe that you're going to see more notices, more letters, 226J, that will be going out to these employers based on a 2015 return year. So get your resource checklist together, create your own for your client, make sure, well, you're on that list, so you're already there. Do you know what your clients are using for ACA reporting, tracking, filing? What payroll provider are they working with? Do you have access to specific data that we're going to need and get it quickly because we need it in 30 days? What specific insurance carrier information could I even gather? Could I start gathering some SBCs, benefit summaries, what have you, to just prep work for the client, and also with third-party administrators. And you also want to look at the IRS has also updated their Q&A guidance, Q&A 55 through 58, as it relates here to letter 226J. So let's not get discouraged, right? I ran across this Ralph Waldo Emerson quote. I think it's perfect for what we're talking about here. You're going to have many of your clients, well, let's say not many, let's say some, a few, a handful, hopefully of your clients will receive this letter. But let's remember this. This time, like all times, is a very good one, all right? If we but know what to do with it, all right? So I have just taken some knowledge that was in my brain, and I've hopefully transferred that to you. And I hope that through this webinar and through some follow-up material that we can provide, will more adequately be able to help you support your clients through this endeavor, because you know what? It is still a very good one, because we know what to do with it. All right. So I want everyone, there's a lot of great information there that I just provided. I want you guys to look towards our February webinar. Folks, benefit technology, as is in our title, is transforming the employee benefit industry. And we felt that it was very important to bring some of the kind of the industry leading stakeholders in this endeavor to come together in a panel and join our webinar and go through kind of a panel Q&A conversation about how brokers in the employee benefit industry is starting to utilize benefit technology. We have some of the most forward-thinking individuals that are being on our panel discussion here in February. We have the CEO of Employee Navigator, the CEO of Ease Central. We have the head of sales. Actually, he's listed as EBA's 2017 Rising Stars, okay, from the Bernie portal. We have Vice President of Operations from WolfTracks. WolfTracks is a leading benefit technology platform in the Great Northwest. And then to establish it all, to bring it all into practical application, we have invited a leading agency that has adopted benefit technology as a way for them to transform and drive new ideas and solutions to their clients. And we've invited Kathleen Araños, who is an SPHR and Assistant Vice President of the Employee Benefits Practice of the Lausel Schaff Insurance Agency, to join us for this very important panel discussion. Folks, seats will be limited, unfortunately. So when you get the registration information, please sign up immediately for it, because it will fill up very quickly. So save the date. February 7th is going to be our next webinar, and it's a big one. So with that, we want to thank you for attending. You guys, as I'm looking, you guys have asked some very good questions. I've not, for the sake of time, been able to tackle everything, so we will get back to you on your questions, but thank you for doing that. Listen, all the attendees here today is going to receive a link to the recording. We publish those publicly on our YouTube channel under Broker Concierge, so please, you'll see our email, and then you can go there once it has been posted. If you're a Broker Concierge partner, you will receive a copy of the presentation slide deck. And we've also provided, PrimePay has created a kind of a flyer that you can hand to your clients. That's, again, this is you getting ahead of the curve, right? Starting to talk to your clients, preparing them for maybe what is coming. And that's called our ACA Employer Mandate Penalties are near flyer. All right. And so for those of you who are not BC partners here today, I encourage you to seek out our Broker Concierge Specialist. That's part of our program, because what we're doing is that we're inspiring brokers in achieving objectives in 2018. And these are not our objectives, they're yours. And we've got so many great things planned for you, the benefits broker. And so we're excited about introducing new tools, resources, content, education, and much, much more to you in the year that we've dubbed 2018, the year of the broker. So looking forward to working with you here in 2018, and have enjoyed your company today. So that will conclude our webinar. Have a great day, and we look forward to seeing you at our big webinar event here in February. Take care.